reasons of the way a sector is evolving or due to the changes in the environment, the macroeconomic factors as they are changing, a sector starts doing well. And very few people observe it because it is either a new sector or it has not been doing well for many years in the past. So very few people observe it. Some very early, lucky or well-researched investors participate in it. And as that sector keeps on growing, as the conditions in the environment continue to be favorable, those stocks do well because earnings do influence stock prices very significantly, we all know that. So that sector creates a little wealth, more people observe it. The confidence of the earlier investors goes up a little bit and they invest a little more money. Initially people take money out of a bank FD or cash and they invest. Now this process continues for few years. More and more people start observing that this sector is creating wealth, your past experience is good, and over time this process takes 4, 6, 8 years. That is what I have observed. After this has continued for 6 to 8 years, virtually everyone or a vast majority of investors are not just exposed to this sector or this theme, but they are grossly overexposed. Initially they were deploying cash, maybe 1%, 2%, and in the end they start selling other stocks. And this is how you can see, initially there was a bit of fear that this is a new sector. So do I participate in it? You deploy a small amount of capital. You make some money, your fear reduces, your greed comes in. And in stages, you become more and more confident about that sector and the theme because we are all conditioned by our experiences of the past and more so the recent past. That is human nature. So as greed keeps on increasing, the environment is supportive, the news flow is supportive, the media is supportive, analysts are supportive, fear keeps on reducing. And in the end what happens is that the vast majority of people like us are overexposed to a sector or a theme. And guess what happens when almost everyone is overexposed to the same stocks, same sector, same theme? It will naturally become overvalued. And the last stages, since your greed is so powerful and fear is not there, the confidence is so high, now you have forgotten the discipline of diversification in equities. And our portfolios become heavily skewed towards just that sector or theme. So since we have sold everything else has become extremely cheap. And this is what creates an excess in the marketplace. This is what creates what we call normally as a bubble in the marketplace. And then how does this bubble end? It has, if you go by past experience, I think there are two ways this bubble has ended. Either the earnings start disappointing, that a stock is trading at 400 PE multiple and you were expecting 80% growth, but the growth is 60%. And it repeats quarter after quarter, the growth rates are slowing down. So that is one way how an excess can correct itself in the marketplace. And along with this, something else also happens. We can see that something, when it is very expensive, there are many people who are smart. They could be entrepreneurs, they could be large shareholders, they could be mutual funds, they could be the owners of these companies. So these companies will start issuing new equity. They will start issuing new shares. And the supply of stock in that space increases dramatically. Initially it gets absorbed as investors sense opportunity, but the supply just keeps on increasing, and this is what eventually leads to a correction. And meanwhile, since everything else is very cheap, people, some long-term investors sense an opportunity there, and that is how a new cycle starts. So this is a very simple slide. Maybe some of you have seen it, something similar earlier, but this describes what I have experienced in the markets over the last 25 years. This gives you, in a nutshell, the returns of different sectors in 3 different phases of Indian stock markets. 1995 to 2000 was the IT boom, we all know that. In this period, if you observe on the table below, you will see that IT stocks went up almost 100 odd times, 96 to 97 times. If you look at other sectors in the same period, automobile stocks fell by 30 to 70%. So you can see in IT 1 rupee became 100 on an average, and in automobiles it became on an average 50 paisa. So the gap in returns was 200 times. And when you go back and see, IT was a new business, it was evolving, the market was very large, Indian businesses were very competitive, and they delivered growth, and the sector which was initially trading at 15-20 PE multiple eventually peaked at between 300 to 500 PE multiples. When IT was the most popular, when everyone was heavily exposed, if you looked at anything else, since those stocks had fallen sharply, they were trading at 1, 2, 3 PE multiples, below book values, at 5, 10, 15% dividend yields. And that is what set the stage for the next cycle. If you look at the second cycle, which coincided with a sharp upward movement in macroeconomic conditions in India, with low interest rates and with a upward move in commodity prices also, because China was emerging as a very major and a fast growing economy, you can see in this cycle the best performing sector was capital goods. These stocks went up on an average 30 times. So I have experienced BHEL go from 100 rupees all the way to 3,000 rupees. And you can see automobile companies, retail banks, corporate banks, refineries, all these sectors did extremely well. IT, FMCG, pharma did not do as well in this period. By Jan 2008, this process had continued. What began in 2001, the same cycle continued. Investors continued to gain confidence in commodities, in capex, and by 2008 we were in a situation where a company like Jaiprakash Industries market capitalization was same as Hindustan Lever. Now you can look at that, this is clearly, it was giving you a clear hint that something is wrong, but the confidence in infra stocks was so high, and since consumer stocks had not done well, people thought these are useless stocks, and that is what created this aberration. If you again go back and see in 2007-8, the supply of new shoes, new stocks in that space infra was very high, just like it was in 2000 in the IT space. And that is where that cycle ended. We all know what has happened to the infra cycle in last few years. And that set the base actually for the third cycle, because the consumer stocks, pharma stocks had not done well, though fundamentally they were very good businesses. They were simply out of investor favor. So in around 2005, 6, 7, you could buy FMCG companies in low double digit PE multiples, and today they trade at 40, 60, 80 times. So you can see how cheap they were way back then. And if you look at the last cycle, it has been completely different yet again. In this, the best performing sectors are in pharmaceutical and FMCG. Now the macroeconomic conditions also play an important role in this whole exercise. If you look at the conditions of macroeconomy in 2001 to 7, we had stable currency for 10 years. Rupee was stable. We had by and large low interest rates. We had low inflation, which is not very favorable to exporters like pharmaceuticals, is not very supportive of faster growth for FMCG companies because inflation is low. And it is very supportive of capital expenditure because interest rates are low. If you look at last 7, 8 years, it has been very different. Inflation was very high in double digits. Currency has fallen from 40 rupees to 70 rupees broadly. Interest rates have been extremely high. Therefore, the growth drivers of earnings shifted to companies which benefited from high inflation and from low currency, which was pharmaceuticals and FMCG. And it hurt companies which are hurt from higher interest rates, like in the capex space. Now, where are we today? I think we are on the stage of yet one other change in the cycle in equity markets. If you look at the macroeconomic conditions today, interest rates have fallen. For the first time in many, many years, probably first time ever, FDI in India, foreign direct investment, is 4 times that of current account deficit. And that is why, despite record selling by foreigners in the last quarter of $10 billion between equities and debt, the currency is still doing quite well. So I think we are looking at an environment where currency should be stable, interest rates should remain low, and inflation should remain low. Low interest rates benefit companies immensely. Mr. Buffett has said that interest rates act like gravity on stock prices. So lower interest rates will drive profit growth up, and it will drive up the fair PE multiples. But the drivers of profit growth are shifting, because now companies which benefit from lower interest rates, stable currencies, revival in capex will grow faster. And this is what I think is, this is the stage where we are. But if you look at the majority opinion, it has been consensus can be right sometimes, but it can also be massively wrong. And if you go back and see in late 99, 2007 and today, around the peak of the earlier cycles, these were the most popular investments of those times. So this is what I have learned from experience. This is not there in any textbook, and I thought of sharing this with you, and I hope you find it useful. Thank you. Any questions here?
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.